Guys, it's May the 9th, and we're seeing a pretty bloody day on the markets. Let's go ahead and share screen. There's not really a lot going on today, so I'll try to keep this as short as possible, but I say that every time, and it always seems to go a little bit longer than I want. Past performance is not indicative of future returns. You can see how bloody the market is this morning, with the indices down, again, trying to push downwards. And I think that there is a little bit of something to be said if the market is trying to sell itself in May and so that people can go away. It kind of tells you the bias that we're going to experience in this very volatile summer until things kind of straighten up. I think in these kinds of markets, you really just have to be very certain about what it is you want to do and then just take a higher discount. It's really interesting coming out of this, some of the themes that I saw within the earnings reports. They're still very mixed in the sense that, I've got about half of the companies doing extremely well and then half not doing well at all. And yet that is not necessarily yet playing out into the markets. You've got companies over here, some of which are doing fantastically, but a lot of these really should not be getting the valuations that they're getting in this type of market. And I will be looking for places to try to take short exposure, but just not necessarily today because you've got a very bizarre repositioning. For instance, Clorox, which guided downwards yet again on the quarter, trades at 30 times, which is significantly above something like Google, which also it missed, quote unquote, the estimates, but still experienced top line and bottom line growth of 10%, despite taking almost $500 million worth of charges for Russia, Ukraine. So yet that is trading down below a 20 multiple at this point. So I think what you do in this market is you just make sure you have cash. You give it a little bit, and on days when you can kind of see that there's going to be some kind of news flow, we've got CPI middle of the week that's just going to basically call for inflation again. You just take a look and you try to own for the long term. I would say the one area of weakness that makes absolutely no sense is the energy sector. You've got big cap energy down 6%, despite the fact that it's probably the only place where you have certainty that if you're not going to get it on the stock price appreciation, you will probably get it off of the dividend yield, because the dividend yields on this are super high. And let's talk about that for a second. I just want to show you Apache. I was trying to prepare some of this, but it's not straightforward. These are the prices that Apache is getting right now for energy. Last year, it was still profitable. It was one of the few that was actually doing okay. We've had almost a doubling, and that's not really taking into consideration the fact that they are not going to be producing onshore. They will be focusing in on Egypt because they can do it at a better price there and then ship it directly to Europe, who is desperate for oil and nat gas. And you can kind of see the pricing is almost a double from last year and then even from December. So obviously they mentioned that they would be returning capital to shareholders, et cetera. And when you look at the growth, it's 80% plus top line growth, 500% increase in earnings per share, buybacks for sure. So the energy sector in general will be out supporting their stock at a price, and probably that price is much lower than, probably the price is more or less where it is right now, because essentially if you're growing the top line at 80%, you're growing the bottom line at 500%, you're probably the best use of your own capital, rather than even CapEx. And just across all of the energy companies, they were very clear that they will not be doing stupid M&A, and they will be growing projects at a pace that makes sense. And it's interesting because with nat gas, there is a little bit of a different dynamic, because when you drill oil, you do also just get nat gas as a byproduct, and that can shift the price of oil and nat gas quite a bit. Nonetheless, there's a desperation going into the summer months for people to go ahead and stockpile or get access to, or go ahead and do any number of things, because if the summer's hot, more than Europe is screwed, I'll tell you that much, because we have run our reserves down and there's a lot of special going on. This was a chart that came out of Devon Energy's deck. And I just want to remind people again, its energy is still a really small segment of the S&P 500. And we know for a fact that whereas that might have been okay when no one was going to invest in energy and let it and the capex associated with it, that's just not even making any sense right now in this environment where we know, and I think people are starting to become akin to the fact that part of the reason why we've had this astronomical growth over the last decade is because of low price of energy and what that implies for just being able to support your company at cheap rates. So we shall see how long this persists. Devin, this is the enterprise value to EBITDA, I think, is a better metric than earnings per share. The S&P now trades at around 13 times EV to EBITDA. And that's something I'm going to do a video on soon because everybody's all about price to earnings, price to earnings, price to earnings. I think it's stupid without another way to say it. I don't know a nicer way to say it. It's stupid. You just had 3 to 5 years of the greatest amount of mergers and acquisitions, and you're going to use price to earnings, which essentially means everything that's happening below the line that is making it look like the companies, in fact, are less valued or whatever you want to call it, or inflated in price. You didn't take into consideration the debt. You didn't take into consideration the fact that there's a bunch of below the line charges that are one time in nature, and you're going to do your valuation and say that the S&P is overvalued at 20 times. It's just ridiculous. It's absolutely ridiculous. But at 13 times, I think that's actually correct and reasonable. And yet still, the energy companies on an EV to EBITDA basis are single digits. In this case, 4 times for Devon Energy is ridiculous, given that it will necessarily return back a ton to shareholders and buy back a ton of stock. Like I think 3 billion is now what they're able to buy back, significant part of the float. Okay, so let's remind everyone that it's not about just the market cap and shares outstanding, but it's about how much float there actually is on these companies. And you got to think usually for any given name, about 40% of the float is owned by indexers. So indexers, passive investors. Anyway, so that's kind of what I'm seeing. And so in these weak market environments, I think what you want to do, if you don't already have your favorite names in the portfolio, especially in raw material and natural resources, raw materials, you want to go ahead and get them. Now, there was an interesting thing that, I'm watching very much so for what's happening overseas to see how it spills in. And one of the areas for which there's like a bit of a run on the currency is Zimbabwe. And I have no bid or no anything for Zimbabwe, but I was looking into it. And I'm like, this is dumb. Zimbabwe is actually one of the bigger producers of nickel. So let's see how far that goes. A lot of these, currency markets are going to play with the emerging markets because it's their right to do so. And that's what happens when you're worried about kind of broader economic situations. But I think it's really dangerous because it turns out that that's where all the raw materials are. And I think you're going to see a lot of volatility coming into that. And it's not the area for which I'm watching, but I found it a curiosity. Anyway, with that, I'll go ahead and hit the pause button because there's really not much going on today with respect to reporting or economic data. So this is really just a trader's market right now. How's it going, Dave? Any questions?
No, I mean, it looks kind of like a meltdown, but stocks will get to a price where they are attractive again.
Yeah, I agree. It's just how it is. I mean, I think out of everything, you do have a little bit of sector rotation for once in tech and in small cap. And in fairness to small cap, anyone that might be like, I'm getting out of the Russell or I'm getting out of small cap names, a lot of those names do depend on M&A. And while a lot of companies have a ton of cash, it's whether or not in a rising interest rate environment, you want to do it one way in financing versus another way. Now, I think that is still a little bit stupid because most companies are still very clear that they're happy to buy growth at a reasonable price instead of just developing internally. Additionally, you still have people purchasing headcount by buying a company. But nonetheless, legitimately, I can see why Russell might sell off a little bit more aggressively. And I can see why, in general, the market at large might want to rotate into other sectors outside of tech, since it's been so much of the market cap has been in technology for the last like half decade or so. And now I think there's some more interesting things going on in industrials as well as in energy and raw materials.
Yeah. Until, it gets really attractive. I mean, you buy the market, you're in a bear market, you buy puts on rallies. I mean,
yeah, I think that's true.
Make it both ways.
Yeah. Yeah, and the vol is spiking like crazy to represent that now. So that's really the only way that you could hedge is just buying puts on rallies.
Right.
Yeah. Anything else?
That is it.
All right, we'll keep it short then.